Thanksgiving's not here just yet, but here's something you can already be thankful for.
Actually, I think we maintained, but I certainly expect a number of breaking trends at times. I just don't see a worrisome correction ahead. I just see market testing.
That's Tom Stringfellow, Chief Investment Strategist at Argent Trust. He's our big interview today, and you can definitely be thankful when you hear a forecast that does not include recession. He's batting cleanup today. Leading off, Todd Rosenbluth, head of research at Vetify, here with his ETF of the week, a truly seasonal pick, a day early because of the Thanksgiving holiday. Then, Sarah Enright, Senior Director of Safety and Sustainability at Consumer Reports, is here talking their proposed homeowners insurance bill of rights. And then I will talk about something that I'm particularly thankful for, which really involves, as much as anything, a change in my attitude that is changing my life.
And away we go.
Welcome to Money Life for November the 26th. I'm your host, Chuck Jaffe. You know, that last one may sound like it's somehow ominous or something along those lines. No, I've got a lot to be thankful for. And yes, some of it I'm noticing now has been some changes in attitude, I guess. And I'll talk about it as we get there in order of the show. I'm not going to give it all away right now, but I will say here, and I'll say it again later, when you've got a lot to be thankful for and you start to say that, it sounds like, hey, look at me, I'm doing so great or whatever. And that's not really it. I just think that we don't have enough conversations about money and its place in our lives. And I think it's very interesting that I've had some changes in my life and in my thinking that are years and years and years in the making, but I'm not sure I ever realized that I would get to this point. So I think it's an interesting thing. Figured I would tell you about it. I am Chuck Jaffe, financial columnist, journalist, your host here on Money Life. I've been doing this show since 2012. I did live radio, and the original Money Life was live radio on WBIX in Boston. I was a syndicated financial columnist for 30 years, most of that time based at MarketWatch, but also at the Boston Globe. That's where I started becoming a syndicated columnist, and I'm still writing. We don't talk too much about it, but I am. And you can follow me on LinkedIn if you want to see when I'm writing stuff occasionally. If you want to see some of our clips, we, of course, post our clips on Facebook and on Instagram and on Blue Sky, and follow us in any or all of those places on X. And the show is on YouTube. It's on every podcast platform. We seem to be through the problems we were having getting the show up, but maybe you tried a new podcast platform and you enjoyed it. So maybe you're sticking with us. Wherever you are finding us, we appreciate it. And we'd be that much more thankful if you're thankful for Money Life and you want to do something for us. Make sure you're liking us, giving us a good review, all that other stuff, because those things really do help. And I realize if you've been here for a long time, you probably have done that for us already. You can go back and do it again. It's never too late to do that. But all those things, whether you're seeing our videos and liking them, we really appreciate it because they do make a difference. Those reactions spur more reactions, and all of that stuff is good for us. And we're thankful for all of you, and I really do appreciate you being here. We are going to be here on Friday. We're not taking time off other than for the Thanksgiving holiday, which for us will be quiet. We're going to go see a movie after we've had a quiet Thanksgiving dinner. But we're back here on Friday, and then we get into December. And let me tell you, the show's super exciting with the lineups we've got coming. But right now, it's the lineup we've got today. Again, it's Todd Rosenbluth, Sarah Enright, me, and Tom Stringfellow. And the ETF of the week kicks us off next.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today. The experts to talk about it. This is the ETF of the week. Yes, welcome to the ETF of the week. A day early this week because of Thanksgiving, but it's the same great information you've come to expect because here we are examining trending, new, newsworthy, unique, and intriguing exchange-traded funds, and we're doing it with Todd Rosenbluth. He's the head of research at Vetify. And if you go to vetify.com, you won't just learn more about Todd, you will learn more about your favorite or maybe your next favorite ETFs. Todd Rosenbluth, great to chat with you again.
It's great to be back. Happy early Thanksgiving.
And to you too. And of course, since we are both Michigan grads, this is a big week to say go blue.
Yeah, go blue.
But in honor of Thanksgiving, your ETF of the week is
The Amplify Online Retail ETF, iBuy, I-B-U-Y.
iBuy, the Amplify Online Retail ETF. And I know, Todd, you are not on Thanksgiving week picking this because it's a turkey. You're picking this because, well, hey, it's the official start of holiday shopping season.
That's right. It is the official start of holiday shopping. In fact, it feels like it already started based on the number of packages that are already showing up at my house that I see being delivered around my neighborhood in New York City, and I'm sure is happening elsewhere. So online retail is a long-term trend that's been going on for a good period of time. The forecasts are that online spending is going to double in the next few years. The forecasts are also that it's going to be another good holiday shopping season. We shall see if that's the case. We could probably get into consumer sentiment is a little bit weaker than it's been in the past. And that is likely to encourage people to go online and look for savings and look for deals. So this ETF, iBuy from Amplify, offers you a diversified way to get exposure. We can talk about what's in it, what's also not in it. But this is a thematic ETF, well diversified. It has Amazon, which is probably the poster child of companies you would think of in the online retail space, but lots of other companies in similar equal size. I think this is the right time for people to be thinking about online retail and perhaps investing in online retail also.
I'm going to step in right away because you talked about Amazon and similar equal size. Let us talk about the portfolio construction here, because when you talk about equal size, that's about equal size in the portfolio, because this is actually much more of a mid-cap fund, and it holds companies that you would think of certainly as online retailers like the Expedias and the Wayfairs and the Chewies of the world, but it also holds some smaller online retailers.
It owns smaller online retailers, and then it also owns companies that are supportive of the online retail industry. So a company like Upwork or a company like Liquidity Services, they are providing things that make online retail work even better. So supporting of the websites, supporting of the people who ultimately end up helping to drive things. So this to me, and this is my approach and my preference when you're looking at a thematic strategy. You want to have diversification across the theme, up and down the food chain. If you believe in online retail, sure, go buy Amazon as an individual company. You are subject to the whims of Amazon's individual reporting results. They've been doing quite well. I think it hit another key milestone from a market cap standpoint recently. But if you're going to buy an ETF, you want the benefits of diversification. This index-based ETF offers you that. And before I forget, we at Vetify are the index-based provider supporting Amplify for this. I'm not getting paid as a result of this conversation, but we are there. I want to make sure I'm disclosing it.
We appreciate the disclosure too, because we want to make sure people understand that the advice really doesn't have anything to do with those ties, but that those ties exist. But you mentioned consumer sentiment, and consumer sentiment is down as we enter the holiday season, and people are talking about how inflation and everything else is going to impact their plans. But although this is the online retail ETF, because it has a lot of those support companies, those companies should do well just because of their business, regardless of whether we come away going, ooh, it was a great retail sales or a bad retail sales year. So this should have a little bit of a buffer, not completely, because it does have the retail companies as well, but at least a little bit of a buffer if this retail season winds up being nasty.
Yeah, I think so. Again, we shall see. And of course, the stocks inside are going to be the driver. But I think a diversified approach as opposed to just picking one or a handful of individual retailers. And there are both other consumer discretionary ETFs or other retail ETFs, and they tend to be concentrated in Amazon because they're market cap weighted. And so Amazon is the largest consumer discretionary stock. It is heavily weighted in those ETFs. But Before you get to the question, maybe you're not going to get to the question. People own exposure to retail within a broadly diversified portfolio if they own the S&P 500, or even if they own the consumer discretionary sector SPDR ETF, which is a popular fund. But they also own other aspects of consumer discretionary also. McDonald's is a large position in the S&P 500 and that sector. Tesla is as well. I would not equate either of those companies with online retail the same way that I would what you'd find in iBuy.
You are not a trend follower, but this is an ETF that is really interesting in the middle of the trend following mix. It just went above its 200-day moving average a week ago. It had been above it, then it dipped below it as we got into November, and it just went back above. But it is below its 50-day moving average and its 20-day moving average. So short term, this has been trending downward. Longer term, a little bit better. When you're talking about a thematic ETF, we're talking about it the holiday season. But iBuy has been the ETF of the week before, and it wasn't during the holiday season. It was because you wanted people to see this. So thematic, does that mean you're making an allocation because you believe in the theme? You think online retail will be a thing for a long time? Or thematic, I want to be buying shopping stuff around the holiday season?
The former, I guess, if I got that correctly. This is a long-term investment trend. This is, as opposed to artificial intelligence or cloud computing or cybersecurity, those are all technology-driven long-term trend and thematic strategies. This is more consumer related and consumer discretionary, not exclusive, as we talked about, of the companies that support this. But this is a long-term trend. I like to highlight a few thematic ETFs as we go through the year and perhaps use the time period to help justify why we're talking about it now. That's what fits in here. We're talking about online retailing because people are thinking more and more about online retailing, but this is a trend that spans the whole year, the calendar year. Again, anecdotal information. I'm getting lots of packages at my house. It's the way that we shop in my family. I'm sure it's the way that many listeners are shopping in their family also. And I think that trend is going to continue, which is why iBuy is in focus right now.
I would say I try not to be too much on the online shopping. I still love being able to do it, but I have morphed towards much more of it all the time. And if I'm getting there, I figure, yeah, I'm certainly not going to be the early adopter. It means everybody's adopting it. Just the same, as we look at this fund, this is index-based. We talked about who provides the index. Yet some people would say that if the expense ratio is 0.65%, 65 basis points, that's a little high for an index-based fund. We can buy a lot of sector funds in other sectors that are coming way cheaper than this.
Right. So fees matter, but fees matter to me less when you're looking at a thematic strategy because they're differentiated. And so the performance is going to be quite different based on how an ETF is constructed. So a market cap weighted approach to thematic investing is going to perform quite different than a more equally weighted. I think this is modified, but more equally weighted approach. I think you need to judge the fee as part of the totality of the ETF. If this ETF is providing you the exposure you think is appropriate to get tied to that theme, then that fee is worth it. Obviously, you want to pay as little as possible. That's why people are going online for their shopping experience, is for the savings. But you need to also understand it's not just the only thing that matters. I wouldn't buy the cheapest garment of clothing just because it was on sale. I'd want to make sure I was getting what I wanted.
And as you point, it's always been in the fund world that you might look at higher expense ratios, but it's going to be what gets you into certain markets, whether it's emerging markets or things that are going to have higher different levels of cost because the research is higher, or in this case, the theme. And the theme is retail because we're at that time of year. It's the Amplify Online Retail ETF, the ETF of the week from Todd Rosenbluth at Vetify. Todd, great stuff. Happy holidays. Go Blue. We'll see you again next week.
Yeah, happy Thanksgiving.
Todd Rosenbluth is the head of research at Vetify. Go to vetify.com for more information to use their tools to make yourself a better investor. And of course, Todd starts us off normally on Thursdays, this week on Wednesday, but we are just getting started. That hasn't changed. Up next, I'm going off the news with Sarah Enright from Consumer Reports. Later, I'll talk with Tom Stringfellow from Argent Trust, and I'll tell you what I'm thankful for this Thanksgiving. This is Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Welcome back to Money Life, where we are going off the news. And the news specifically, well, it's about the housing market and the home insurance market, but it's specifically about some work that was done by Consumer Reports. Because at the end of October, Consumer Reports released a homeowner's insurance bill of rights, which outlines 9 basic protections that Consumer Reports thinks every homeowner should have. This was based on research, Consumer Reports gathering hundreds of stories from over 50,000 consumers trying to develop solutions. And on the one hand, this is something that we hope would happen, but I don't know that it's going to, and we'll talk about that. On the other, the more you know, the more you can say, wait, I want to make sure I'm getting what I need for myself at the very least. Here to discuss it is Sarah Enright. She's Senior Director of Safety and Sustainability at Consumer Reports, which is online at consumerreports.org. But if you want to go directly to the Homeowners Insurance Bill of Rights piece and the 9 protections, there's a link where she's mentioned in today's show notes and on our guest page where you find her at moneylifeshow.com. Sarah Enright, welcome to Money Life.
Thank you so much for having me.
A Homeowners Insurance Bill of Rights. I kind of want to know which came first. I know from reading the story that you got hundreds of stories from consumers, but did you get those stories and then go, this is an emerging building problem, and go out and do more research? Or did you do the research to go, we wonder, and we find the complaints? Like, how organic was the complaint process here?
This really started with the heartbreaking floods that took place in North Carolina last year, followed very soon after by the wildfires in LA. We started to hear that homeowners were not only not prepared for those extreme weather events, but that they were immediately having trouble getting compensation from their insurers. And so with rising cries across the country that insurance rates are both going up and not covering what people expected them to, we decided to go in a deep dive and look at what's going on. So we put out a Tell Your Story request and immediately received over 550 responses from people telling their individual stories from across the country about sharp, unexpected premium increases, loss of coverage in entire communities that are deemed to be too risky by insurance companies, and struggles to get compensated after a disaster.
Of course, the insurance industry has been the untold story of inflation, right? Where everybody's been worried about the price of eggs. As I've pointed out, in the last 3 years, I've seen my homeowner's insurance go up by more than 50%. And by the way, that increase just from last year alone, 2025, when I paid at the beginning of the year, would have been enough to buy me eggs pretty much every day for the rest of my life, let alone that I'm paying that annually. How much of this is people who haven't read their policies? Because, for example, the first right that Consumer Reports is asking for is a clear, plain language explanation of what is and what is not covered by your policy, which every homeowner should have. And yet, I talk to plenty of people who I know have never read their policies. So you could have plain language in there. It doesn't help you if you don't read it. So are consumers contributing at all to these problems?
It's an interesting question. So you're absolutely right. Insurance prices across the country have gone up on average by 24%, but for many people, much higher than that over the past 5 years. That has been driven by a number of factors. That's been driven by the rising cost of construction of new homes. It's been driven up by inflation, by increasingly powerful extreme weather events. So there's a number of systemic factors involved in price increases. It's not just insurance companies charging more. So when we looked at the Bill of Rights, we thought, this is not just one company being a bad actor. This is an entire industry that's struggling, and also, not taking steps to protect their consumers through this period of change. So we looked at how do we put together a comprehensive set of rights that protects consumers when they're shopping for insurance, when they are engaged with their insurance company under their coverage, and then when after a disaster, how they are compensated afterwards. And really look at how do we put protections in place across that full relationship arc so that people are better prepared and covered. As to your point on whether people are reading their policies, many people do not know what there is in their policies. And that is the first and most important step for any homeowner. Read your policy, understand what is covered. Many people do not know, for instance, that most homeowners insurance policies do not cover flooding, and you have to get separate insurance for that.
And that's one of many, many different risks and potential places where things wind up being problems. How much of this is about changing best practices in the industry? How much of this is about changing laws?
We have written the Bill of Rights to ask for voluntary changes by insurance companies, basically looking at what we think is feasible for insurance providers to provide to all policyholders, regardless of what state they live in. Insurance is regulated at the state level, largely in the United States, which means that insurers are beholden to 56 different restrictions on how they manage their insurance policies. We'd love to see insurers provide some of the best protections that are offered in some states across all of their policyholders. What that means is we can ask for voluntary change. We're also then talking to a number of state lawmakers who are hungry for options for how to better protect their homeowners. And they are actively looking at legislation changes to better regulate home insurance in their states.
When you consider the various pieces of this, one of them is one that I think everyone should know about that most don't, which is, while we all know about our credit scores and the importance of credit scores, most people don't know that insurers effectively have their own insurance score, which involves your credit score, and then it involves a number of other factors, which may or may not be related directly to you. This is one where, given that all the banks have their own credit scoring system, even though we have a general credit score, can we expect insurers to tell us what they're looking for and get to where we can say, okay, I want to be a better insurance risk and improve my insurance score? And oh, by the way, maybe get better premiums if I can improve my insurance score?
First off, Consumer Reports believes that fair pricing of homeowners insurance should be based off of the condition and risk exposure of your home, not off of your credit profile. So we are advocating that insurers not use credit scores in order to set your rates. That has been legislated already in 3 states, California, Maryland, and Massachusetts, but is a widespread practice otherwise in other states that insurers will use your credit scores as part of your ratings. You don't have a lot of control over how an insurer is setting your rates, but you can ask them to tell you what are the factors that they consider and whether there are opportunities that you can take, investments that you can make to improve your rating with insurers to see if you can reduce your premiums. So I think that's an important conversation to have with your insurers is what are the actions that I can take to reduce my costs?
There are 9 different rights here that you want to see enacted, but what are the 1 or 2 that you think people would benefit the most from if they were aware of them? Because I just don't think everybody's aware here.
What we'd like to see is that insurers partner more closely with their policyholders to make sure that they're better informed about what risk factors their homes are facing. In many cases, people do not know that they are living in a zone that may have active fire hazards or floods coming in the near future. Your home insurers do. And so we'd love for insurers to provide more information that they see to their consumers so that they can make better decisions about how they protect their home, where they live, and what investments they need to make to stay safe. We also want to see insurance companies provide meaningful incentives for homeowners to take the steps that are needed to harden their homes, because that reduces both risk to the households, to extreme weather hazards, and it also reduces the risk that insurers are going to have to make massive payouts after a disaster. So it's a win-win opportunity, and we'd really love to see the insurance industry step up in that way.
Every one of these things is really viable and important. I will simply say the one that I want consumers to know about is that number 7 here would be to face no penalties for inquiries or unpaid claims, because you should be able to check out, do I want to put in a claim? Is it worth it for me to put a claim in? And not have it count as if you put in a claim and have that potentially impact your future insurance rates. And that is one that until you know that that is the case, you might sit there and wonder, why did my insurance go up anyway? You would want to make sure that that's not happening to you. There's that and so much more here. Sarah, I really appreciate the time. Thank you so much for joining me on Money Life.
Thank you so much for having me.
That's Sarah Enright, Senior Director of Safety and Sustainability at Consumer Reports. It's consumerreports.org. The link to their homeowners insurance protection rights is on our guest page and in our show notes. And you have the right to more of Money Life, and we'll uphold that right in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
As we get to Thanksgiving this year, I'm perhaps more aware than ever of just how much I have to be thankful for. I'm going to say it's hard to talk about these things without sounding like I'm bragging, but I'm really not. Instead, I'm trying to key you in on a couple of changes that I've been finding in myself, and they may feel a bit strange to me, but they also feel wonderful. Now, of course, I do have the obvious things to be thankful. I love my life with Gail. I don't want to sound like a giddy schoolboy. I'm crazy about her. And I also get to feel adored every day, which is just amazing. But I also have my kids, Thompson and Whitney's husband, Greg. And while they live about 10 states away from me, it doesn't feel like that. And of course, Whitney this year had my first grandson, Declan. There he is. And if I'm this enamored of him when I haven't spent much time with him, I can't wait for more. And I'm also blessed by the close relationship I have with Gail's daughters, Taylor and Mackenzie, who live close by. And they'll be spending time with us on Thanksgiving Day, but we get to see them a lot and talk to them a lot. But my overwhelming sense of thankfulness isn't about those things this year, because those are constant presences in my life. Instead, I'm particularly thankful about where I am with my finances and what that is doing for my life. Now, look, I've always been a saver, a conscious consumer, someone who never wants to overspend, but who does want what I want. I've worked in a business that is not the best compensated, but I've always chosen my passion for the work over the potential to get a bigger paycheck doing something I don't like as much. And if you go back to the beginnings of Money Life, well, this podcast started shortly before I turned 50. And I said at the time, and I've been saying it many times since, that I was anxious, well, first to meet 50-year-old Chuck and then 60-year-old Chuck. But the big guy who I've always been planning for in my life from the time I was in my 20s was 65-year-old Chuck. I've been expecting to meet him for decades, and I've always said he's going to arrive someday and look me in the mirror and say, hey, what have you done with my money? Well, someday is getting pretty close because I'm now 63 years old. And through a combination of savvy investing and dedicated saving and a fortunate market and whatever else, I've stopped worrying about disappointing the 65-year-old version of myself that's almost here. And I've done that because of a stark realization that I never really allowed myself to have until recently. Namely, that I could retire tomorrow and I'll be okay financially for the rest of my life. It's not about being rich or living high on the hog. And it's also not like I'll stop worrying about sequence of return risk and longevity risk, because I will undoubtedly sweat those things until they are no longer mathematically even potentially able to hurt me. But it is about what I've always felt and told my children, namely that money gives you choices and options and, at least in your own life, power. You know, if you've listened to Money Life for a while, that I had a heart attack in 2010. As I went through it, I was on the table saying that when I survived it, I was not going to do work I didn't want to do anymore. But I was 48 years old at the time, and I had kids who were not launched, and I had financial obligations and more that meant I couldn't fully live up to that. I had to do a lot of things that I didn't particularly like or certainly didn't love because they paid the bills or they advanced my career. And not long ago, I had an opportunity that my younger self would have taken just because of the potential to make more money. I won't get into the specifics, but let's just say that it was a chance to grind it out to make more money. And I have always been a grinder, somebody who can just kind of push it out and put forth the work. But as I started to do the work this time, I realized that I didn't want to grind that much, and I didn't love the ancillary stuff that came with this work. And the guys I was doing this for, they're like, Chuck, we love what you're doing. We'd love to see more from you. And I told them, don't expect more because the job has stuff I don't enjoy doing attached to it. Now, if you could get rid of that part of the job, then you could have more for me because I'd be focused on the stuff I want to do. But without that kind of leeway, and by the way, they're trying to make some accommodations, well, the juice just wasn't worth the squeeze for me anymore. And it was less about the money than it was the work. And that's a big sign of money maturity. George Kinder wrote the book, The 7 Signs of Money Maturity. I'm a big believer in it. It's a book that if you want to get into some of this stuff, maybe you should go find. But a big sign of money maturity is also giving money away to charity and more. And I find myself being more generous with my money and enjoying that generosity more than ever. And maybe that's because I can afford it, or maybe it's because I'm maturing. There were 2 passings this year that had particular impact for me. First was Rich Bachman. Rich in Orchard Beach, Maryland, to you guys, who was one of the biggest fans ever of this show, but who had become a pen pal and a friend over the years. And then of Jonathan Clements, my longtime friend and journalistic rival. Both of their deaths had a significant impact on this evolution I'm feeling in my life. When Rich passed, Gail and I had a conversation which I think changed our lives for the rest of our lives. It was about her feeling that, nothing's guaranteed and she doesn't want to wait for the things that will make our life what we want it to be, which is not necessarily traveling around the world, though we'll do some of that. It's much more about things like fix things around the house so that you're always comfortable and never regretful while you're sitting at home and living your day-to-day life. Rich always talked about how he had worked hard to make it, but struggled to spend it. And the conversation that Gail and I had after his death put us very much on the same page. It helped us bridge some of the differences in our personal money styles, and it has made all of our financial and spending decisions emotionally easier, which, by the way, also makes them feel easier financially. Gail and I have done some things recently, and we have more work to do. But where those things might have felt like a financial burden in the past, they don't really feel that way now. It's not like I've become massively more wealthy. It's that I feel like I have full control over my choices and that money has allowed me to make good choices, confident choices. Now, Jonathan's death, and he and I were basically the same age, and we spent our first 45 years of life in parallel careers and lives. Well, it was also a reminder that life is short. But I got a bigger one of those when my brother Rob passed away shortly before I had that heart attack in 2010. But Jonathan, and I urge you to go to our archives to find the interview we did after he got his terminal diagnosis, which we replayed after his passing not that long ago. Well, it sparked in me a desire to surround myself with the things that are important, but to jettison the things that are unimportant. It gave me permission to get rid of stuff that seemed important and that may have been important to keep at one point. And some of that's paperwork and some of that's possessions and all kinds of things. But it had become a burden, or it would be a burden to my children and to Gail if I didn't handle it. So I'm working on the process, but I'm finding it incredibly freeing. And as a result of all this, I reached Thanksgiving 2025 looking at personal growth and personal changes, and I am truly thankful for it. But I'm also thankful to be able to enjoy the fruits of my labor, my lifetime of saving and working. Look, I'm not changing my financial habits. I'm always going to be frugal. I will always want to be a savvy shopper and a smart saver. I will get too excited over saving my change or using coupons to buy my groceries on the cheap. And I've always had a mindset that life is short, so buy the tickets. But I'm not going to overpay for those seats because whether it's saving or spending for work, well, I don't want to sit in places that are uncomfortable. So this holiday season, I encourage you to focus on the blessings and the peace rather than the numbers. The math confirms what you hopefully know, that you're doing the right things to reach your goals and to live out your life comfortably. But it's the journey and not the size of your accounts that makes your efforts worthwhile. I hope you have a lot to be thankful for and that your blessings will only grow in time. And of course, one more thing I am thankful for is this audience. So thank you for being here and for listening and to take the stuff I say seriously and for writing me and being in touch. Chuck@moneylifeshow.com is how you do that. I've found my piece. I've said my piece. Now we have to go back with one more piece of today's show. Up next, it's the big interview. Tom Stringfellow from Argent Trust will be here. And yeah, I'm thankful that that's coming right after this message.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Welcome to the big interview on the November 26th edition of Money Life. Joining me now, Tom Stringfellow. He's Chief Investment Strategist at Argent Trust. And if you want to learn more, Argent Financial, just like it sounds, argentfinancial.com. Tom Stringfellow, it's great to have you back on Money Life.
Chuck, it is always a pleasure to be able to speak with you. I enjoy it. Thank you again.
Here we are getting into the heart of the holiday season, and we have a market that, well, I don't think people are surprised with the results for this year. Like if I go back to the conversations I was having a year ago at this time, kind of, benign year that the market will push forward a bit and maybe get into low double digits. That was a common thing, but nobody expected us to get here the way we got here.
Absolutely.
Can we hold this, or do we have to have a setback from here?
Well, I think we've been tested here over the last few weeks, and it was a really interesting stress test to see how the market reacted, how investors reacted, and they reacted as expected, which was market sells off a couple percent and people start panicking. So, it's living up to expectations, but it is amazing how quickly it pops back up on the signs or sense of upcoming good news. So, actually, I think we maintained, but I certainly expect a number of breaking trends at times. I just don't see a worrisome correction ahead. I just see market testing.
I think we'll take that. Not a correction. Most people are happy to hear that. Tests of the market, that's fine. But, there's been a lot of bubble talk. Now, the bubble talk decreases every time you get a couple of days that the market deflates a little bit. And then even if it picks back up, it has to go a little higher to get to the bubble. So if you're not worried about a correction, presumably you're not worried that we've got a bubble, even though we've got valuations that I know you think are high, because you can't look at them and not think they're high, can you?
Oh, absolutely. I mean, it's a market, which is different. This time we've seen revenue supporting the bubble, and we've seen such large streams of revenue, AI related. It's definitely still a bifurcated market, but the question is really, what are the correct valuation metrics on the type of income streams and revenue streams that we've seen? And then the follow up to that is, will the expectations of revenues really be supported by the follow through revenue, almost all of which is related to that entire AI channel build out, which runs from the actual artificial intelligence to the data centers to the batteries to, are we going to need nuclear systems? Are we going to need hard minerals? All of that plays into what is a correct valuation. But what is interesting to me is that there are so many areas that are building out the artificial intelligence system. And this truly is a new, I'll call it a technical revolution as opposed to the earlier industrial revolution, where there's a lot of parts ahead that we're still trying to figure out what that really is going to look like. That's the key that makes forecasting this a little difficult and sometimes totally unsettling. Are these numbers real?
In that answer and the one before it, you're bordering on saying this time is different. And those are supposedly the most dangerous words in the investing world. You are bordering on it. You haven't.
I'm bordering, but I did not say it.
Okay.
It's interesting. It is interesting.
How close to different are they? How close are we to you saying this time because this story is so big, because artificial intelligence can affect everything, because to get the computing power, you need the power, but to get all these other things, this and that's going to happen, et cetera. How close are you to saying, okay, at the very least, if not different, I have to throw away some of my expectations that we're going to get a correction every X number of years, or that valuations can't go higher from here?
Well, and we know from past market experiences, a new innovative trend in the markets leads to market enthusiasm, investor enthusiasm, which tends to drive market valuations up. And then some rationality comes into play. Markets sell off a bit, earnings catch up, and then it kind of self corrects the valuation metrics and trends. We're at a point now where we've not had a chance to see that because everything we're looking at is happened in the space of 2 to 3 years, whatever you want to call the start of this, post 2022. So this is so new from our mindset, but it's just been totally explosive. So now we're at the point where we're seeing new innovations that are coming out almost daily and probably more frequently than that. That I don't care how closely you follow it, I don't know that we all keep up with it. For instance, I went to a conference here earlier this year, AI 4, which was Artificial Intelligence 4 conference. I think next year is AI 5. This was not an investment conference for investors. This was a conference for users, institutionals that they were deeply involved in artificial intelligence and everything that was going to help make their businesses more efficient. Interesting in watching what was out there that as an investor I was not aware of because I'm busy watching the companies that are involved, not necessarily the products and the services and the software they're putting out there. Once you start looking at that, it becomes very obvious that there's products, there's real strategies. The question though is the market ready to consume and utilize and make their work more efficient? And is that going to be done while truly maintaining the workforce? Or are we going to worry about that workforce being culled down to bare minimums? And it really isn't going to help the economy much if we have a AI generated economic boom if we don't have the consumers with good paying jobs in the middle of it, helping to boost the economy. So, that's one of the factors. Will AI totally replace the higher levels of income, or is it going to be replaced by people on the sidelines monitoring the meters? And that's still to be seen. Right now we're seeing layoffs seemingly building up. And is that in anticipation of a economic malaise in the next year or so? Or is it an excuse to start culling workforce in anticipation of staffing that won't be needed because of the efficiencies of AI? So, yeah, I look at it and say, I can do things now without a team of analysts that, courtesy of AI, I have a lot of the data generated that I need. What I do know though is a lot of the data that's generated, I still have to double check to make sure that it is timely and it is real. I don't expect that to be an issue, a year or two from now. But I've got things in my fingertips that otherwise, if I were involved in pulling the data, that would take some time. If I had a team pulling it takes some time. But it still needs that team at this point in time to help understand where all that data fits in our environment. As I've found with AI, it understands its world, but it doesn't quite understand what we do with the information that we use from it and how it works through our thought process. That's the next iteration.
Yeah, well, it's, potentially garbage in, garbage out is the problem, is that you can ultimately, that's why, there's some expectation that AI will not just get to everybody, okay, hey, what AI has determined is the best course is an index fund. Just go buy the index and, don't do anything else. That might be the AI solution. But as long as there are people who think, wait, I can use AI to be more efficient or better or to gain an edge or to slice the pie differently, then we'll see how it plays out.
It almost sounds like the early days of Doge.
Yeah, could be. When you look at this market, given where valuations are. On the one hand, obviously, you see all the potential in AI, you see all the things that are going, but is that where you want to be? Or given valuations, is it something like healthcare that attracts you right now?
And that's spot on, Chuck. What has been moved, and I think, or what's been moving in the market, and what has everybody's attention are obviously AI and AI related stocks. I think we've also found that if you really enjoy the volatility of the market, that's what you want to own, AI and AI related stocks. But meanwhile, there's a lot of sectors that have not participated. When you look at utilities, consumer discretionary, communication, technology, those are sectors that have benefited because of the weighting of AI related companies within those sectors. But if you're wanting to look at healthcare, staples, materials, those are sectors obviously that have not participated to that extent. And we're at a point now where healthcare is, I want to say, I read here recently about PE multiple, the healthcare sector is about a third of the S&P. That is a valuation level that we just don't think is sustainable, especially given that there are so many, and here's the real interesting part of it, I think, is there are so many technological advantage discoveries in the medical fields, courtesy of what's coming through with AI. So, the one sector that we've actually seen a valuation boom in is now getting involved in those sectors that could push research from 3 to 4 years to 1 to 2 months. Thank you, DNA work courtesy of AI. So I think there's a lot of advantages that what we've been investing in is now going to help with those sectors that have been kind of moribund, waiting on some synergy. And maybe that's where we now turn to look at where are we seeing new drug discoveries? What's moving through the pipeline quicker? There's just so many areas that I think have been untouched, but you're starting to see healthcare rally. And I saw a sector started moving probably about 3 months ago, and I don't think it's anywhere reflective of where it could be over the next 2 or 3 years. So this is definitely a stock picker's market. And as an active manager, I say this on a regular basis. But, a great passive market tends to be one where everything is moving in tandem, not where you have sporadic moves that have sporadic moves to the downside, sometimes quicker and deeper than the move upside. If you have participation across the board, that's where I'd like to see passive. When you have the markets where we have now, and you have volatility at the level we have and the sectors that aren't performing across the board, active plays a very important role where we're sitting back and looking at valuations and just common sense. There is a point where there is a normalization, a reversion to the mean, where things just get too cheap and revenues are still there. Investors are going to reallocate, even if on the institutional level. Monies will flow to where earnings are more attractive.
Where valuations have been more attractive has been internationally, but there's some concern there that what we've seen in international this year is less about valuations and more about the dollar and dollar weakness. So, where are you right now on investing internationally versus domestically?
I don't think you can avoid international by any stretch. The international markets certainly look different than they did, back 10, 20 years ago. Your point well taken on the dollar. That has certainly been a boon to a lot of the international markets, but we're not by ourselves in terms of innovation. AI is helping the overseas companies to the same extent that they have helped us. And where you see some attractive markets is going to be where, unfortunately, where we're spending or they're spending more and more dollars on defense spending, innovation in safety, security. You're going to see innovation. You'll probably see consolidation in some of the banking industry. So, that becomes very interesting too. The international markets are probably going to remain a higher dividend yielding market for those that are looking at dividend stocks. But obviously, you have the risk of currencies in that type of investment. But I see interesting valuations. And this is where I'm more prone to use ETFs for the market regions, looking at valuations in that part. You know, we believe in international, but we're not out there picking individual securities within those markets unless they happen to be those companies that are also traded in ADRs in the US.
What's your take on what happens with rate cuts and what does that do to the fixed income or income generating side of your portfolio?
It's always been difficult to predict rate cuts and rate hikes. It's even more difficult when a lot of the economic data reporting services that we used to look at aren't reporting. And today I was looking at a couple of articles said, we're going to have a few more things somewhat delayed. So, trying to get a handle on what inflation really looks like these days, even though there may have been a few discrepancies in the past. Well, now we're truly, just kind of in the dark at this point in time. But the volatility of the market still tells me that maybe we do have a shot of another rate cut before year end. And I think the odds of a rate cut, probably another quarter point, is moved up to think maybe 25 basis points. We'll see if that happens this coming month. I'd be surprised if it's any more than that. So I can't look at that being the reason we see a rate cut coming up. But I don't think we're out of the woods yet from an economic perspective. Like I said, I think we are somewhat more stable in terms of where the market is right now. So I'm not expecting a huge impact on the market. But I think as we see the rate hikes out of the picture, as we see rate cuts by virtue of a slowing labor market, and I think that's going to be very key as to why we may see any kind of cut. The labor market, I think, is somewhat worrisome in terms of what probably is going to come up in initial claims. The JOLTS data doesn't look reassuring. So I think we do get a no rate cut. And, that's going to bolster fixed income market somewhat. It doesn't provide a headwind to the fixed income markets. New issues, from what I've understood in municipals, stays strong. Same thing in the corporate markets. Rates have come down a bit, and I think we're seeing a lot of new issues, debt issues, corporate market, primarily from AI related companies. They're needing to raise cash. That also begs the question down the road of, have they raised too much cash? Is there too much AI related debt out there? That's where the conundrum is. Is the revenue going to be generated to pay for the debt that's being incurred to build this out? A lot of articles out there that you've read says maybe not.
You talked about how the economy is not out of the woods yet. Yet again, you don't think there's necessarily bad things happening.
I'm not looking at a recession.
Okay, because that's where I was going. So you're not looking at a recession, but how long can we go without a recession? Like, is it 2027 that we're looking? Like, we've avoided recession to this point, and we kind of understand why. And we did have things like the taper tantrum that kind of beat some of this out. And people talked about, it's a rolling recession or what have you. Recessions haven't been repealed, have they?
No. And I'd say that recessions, more times than not, I would attribute to bad policy decisions that have contributed to the recessions. So I would say that next recession will be subject to a bad policy decision. Now, if your next question is, what's that? I'll say, well, let's wait and watch.
Well, we have no choice but to wait and watch for those. The good news is we'll have you back in 2026 and we'll see what you've seen and if you've seen anything that makes you change this forecast. Tom, great stuff as always. Happy holidays. Thanks for coming back on.
Appreciate it. Absolutely.
That's Tom Stringfellow. He's Chief Investment Strategist at Argent Trust. You can go to argentfinancial.com to get more information, find his commentaries, and more. And we'll come back. We'll send you off to the Thanksgiving holiday, but don't leave before we get to wish you a happy holiday. And we'll tell you what's coming on Black Friday. Stick around with us all the way till the end.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
We're back to wrap this one up. Not much time to do that in, but I hope you enjoyed the interviews we've got today. We are going to take tomorrow off. Of course, it's Thanksgiving Day, but we will be back on Friday, Black Friday. Although we're not going to do too much on the Black Friday stuff, we will talk with Sarah Foster from Bankrate.com on the research that she did that looked at what's happening to holiday prices and prices on holiday essentials. We'll have John Cole Scott from Closed End Fund Advisors, CEF Advisors, here talking stuff about closed-end funds in the Navigator and more. So plan to be here. We'll have some fun. And then we'll be back next week. And man, do we get into great stuff. I mean, following up on this week, seriously, even though it's a short week and everything else, this has been a great week of shows. And man, the lineup for December, super impressive. I'll tell you more about that on Friday. Meanwhile, if you're looking for something to celebrate today, because you want to get it done before Thanksgiving, well, it is National Tie One On Day. And that is why it's also National Jukebox Day, because while you're tying one on, you might be playing the jukebox. But another name for all of that is Drinksgiving or Blackout Wednesday.
Fat, drunk, and stupid is no way to go through life.
And while fat, drunk, and stupid may not be a way to go through life, today is a day to kind of get fat, drunk, and stupid. At least that's what they say, because it's Drinksgiving, because like all the college kids come home and whatever, everybody's around, and they go out to the local bar and they bump into all their old friends who were there, etc. I'm not going to be doing it, but it could be something you celebrate today. I'm more likely to celebrate with cake. And in fact, I'm going to be making my mother's cheesecake, which I've never made before. Her A1 cheesecake. My mom was a fabulous baker, and she made over 30 types of cheesecake. But there was one that, frankly, it looks daunting even as I'm considering doing it, but I will be doing that. But it's National Cake Day. So yeah, let them eat cake today and maybe at Thanksgiving too. My guests today were Todd Rosenbluth, Head of Research at Vetify.com. Sarah Enright, Senior Director of Safety and Sustainability for Consumer Reports. It's consumerreports.org, and there is the direct link in our show notes to the homeowners insurance protection rights that they're proposing. And then Tom Stringfellow is Chief Investment Strategist at Argent Trust, which is online at Argent Financial. Thanks to them. Thanks to Rob Floyd, my producer, and man, am I thankful I've got him as my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Henry David Thoreau, who said, "I am grateful for what I am and what I have. My thanksgiving is perpetual." Yeah, for all the things I told you that I'm thankful for, yes, my thanksgiving is perpetual. But one other thing that I'm always thankful for is that I've got money in the right place, and I hope you will too. And to do that, just remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day and a better Thanksgiving. Stay safe, stay calm. We'll see you here again on Money Life on Friday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Oh, I love turkey on Thanksgiving. Happy Thanksgiving, everybody. Oh, thank you.